Reasons to choose an adjustable rate mortgage. An adjustable rate mortgage, more commonly known as an ARM loan, is another option to consider when determining which type of mortgage is best for you. As compared to a fixed rate mortgage, an ARM interest rate is locked for a certain period of time and can change either up or down after the adjustment period expires. Now, there are different ARM options you can choose from: 1 year, 3 year, 5 year, 7 year, and 10-year lock-in periods. One of the reasons to choose an adjustable rate mortgage would be that you start out by paying a lower interest rate versus a fixed rate mortgage. For example, let's say that you have a job where your income is going to increase in the future, but you want to buy a home now. You feel it's best to start out with a lower monthly payment because based on your current income, it's more affordable due to the lower starting interest rate. Then in the future, as your income increases, you'll be able to afford a higher monthly payment just in case the rate increases after the adjustment period has expired. Or you just may choose an ARM because the rate is lower and you're paying more money towards your principal balance. Another reason to choose an ARM would be that you don't plan to live in the home for a long period of time. For example, this might be your first home and you plan to buy another home and move within 5 years. Or if your job requires you move every 3 to 5 years, you may choose a 7 or 10-year ARM because again the rate is lower than a fixed rate payment. Your payments are lower and you have no need to lock in a higher rate that you would get if you took out a 30-year fixed rate. So the question you might be asking yourself is, what happens to the rate after the adjustment period is over? Not to get too technical here, your rate will be adjusted to a new interest rate, either up or down, and it is based upon an index and a margin that is predetermined when you close your loan. Now, an index is the base interest rate and is the first level to determine your adjustment. Now, there are many types of different indexes, but most of them are published in the financial news. And if you're interested in an ARM loan, I'll review what index will be used and how it has changed over the last few years. Now, of course, the past changes may not be indicative of what future changes might be. The margin is the difference between the index and what your rate can adjust to when it comes time to do so. One more thing I need to mention. ARM loans usually have a payment cap, which means that interest rates, if they go absolutely crazy, you can be assured that your rate will never exceed a certain interest rate. When you apply for an ARM loan, you'll also receive a government booklet explaining how it works. I can also provide you with an historic analysis of what has happened to rates over the last 5 years and give you a worst-case scenario. And to get your pre-approval started today, turn on Turbo Mortgages by applying on our home page.
You're